Okay, so welcome back, everybody. So this is the third session. The title here is of the session is Technology and Financial Structure, and that's because we've got one paper on technology, one paper on financial structure. But there are some connections between the two. And so we're going to start with the financial structure paper. And so I'm very happy to welcome Keling Zhang, who's going to present her work.
Thank you very much for including my paper in the program. I'm extremely grateful for the opportunity to present my early stage work here. I will be on the job market next year or this year. So I think I will get a lot of like the questions and comments from the audience will be, well, let me have a very busy and fruitful summer. By the way, any job openings? Probably too early to ask. So let me start. In this paper, I'm going to talk about intermediation in the mortgage market. This is part of my research agenda on understanding the evolution of the mortgage market and its impact on macroeconomy. In this paper, I'm going to focus on mortgage aggregation market and its impact, its distributional impact. Oh, okay, thanks. Access to credit is a critical component for economic stability and growth. However, it is well known that access to credit varies by income. Low-income borrowers often struggle to gain access to credit. This could be due to demand-side reasons, where low-income borrowers lack credit history or they have low level of financial literacy. This could be due to supply-side reasons, where banks don't have enough branch presence in low-income areas, or they strategically allocate poor financial services to low-income areas. In this paper, I focus on mortgage market and try to identify new supply-side frictions for credit access. And it may have a potentially negative impact for low-income borrowers. I call these frictions matching frictions in the mortgage market, in the mortgage aggregation market. Let me give you more details about mortgage aggregation. Here is a graph for the industry structure of US mortgage market. As we all know that the mortgage market has a very complicated industry structure. So this might be an oversimplified graph. If we look at the securitizers here, we all know that after the financial crisis, most of the mortgages are securitized by Fannie Mae, Freddie Mac, and Ginnie Mae. For simplicity, I will just refer these entities as agencies, though it's not very accurate. If we look at the lender, a lender can originate a mortgage and then securitize the mortgage through these agencies. However, sometimes it's not so simple because a lender may not have direct relationships with these agencies in the market. In that case,
Keling, do you want to talk into the microphone? It makes there's people attending online. It's just something. Thanks.
Okay. Yeah. Do you want to? Okay. Thank you very much. So if a lender doesn't have direct business relationships with these agencies, they have to roll the mortgages through large financial institutions and then get the mortgages securitized. These small lenders that fund and originate mortgages in the market and sell the mortgages to non-affiliated financial institutions are called correspondent lenders here, and the financial institutions that purchasing mortgages from these correspondent lenders are called aggregators here. The examples of aggregators are Wells Fargo, Bank of America, US Bank, and recently there have been increasing presence of shadow banks as aggregators in this market. And my discussant has a very interesting paper on the increasing presence of shadow bank Ginnie Mae MBS issuers. Examples of correspondent lenders are these small community banks or small shadow banks. In fact, only 1/3 of the lenders in the United States have direct access to agency securitization. This is a graph that shows the geographical distribution of the fraction of lenders with agency access averaged from 2009 to 2019. And as we can see from the graph, there is large regional disparity in terms of the direct access to agency, with the fraction of lenders ranges from less than 20% to 100% across counties. The correspondent lending channel remains as a very important channel in terms of mortgage origination. If we look at this graph that shows time series of the mortgages from the correspondent lending channel based on the data from Fannie Mae and Freddie Mac single family loan performance data, the fraction of the mortgages coming from the correspondent lending channel comprises 30% of the mortgage origination in the market. Given the large regional imbalance in terms of the direct access to agency securitization and the importance of the correspondent lending channel in this market, I asked the question, how do disruptions to the aggregation network affect lending, and potentially what would be the distributional effect on borrowers? As an overview, using a possibly exogenous regulatory shock, I find that decreasing mortgage aggregation reduces mortgage origination by correspondent lenders. This potentially suggests that mortgage aggregation plays a very important role in easing the securitization frictions faced by these correspondent lenders. And matching frictions actually matters here. If correspondent lenders have $1 million mortgages for sale, and if they can freely switch between different aggregators to sell these mortgages, then a decrease in aggregation volume from one correspondent lender in network would not matter for these correspondent lenders, because these correspondent lenders can always choose to establish new relationships with other aggregators, or they allocate different fraction of the mortgages to sell to different aggregators. The decline in the credit supply may have important distributional implications for the borrowers in this economy. Low-income borrowers may experience larger credit supply decrease and higher rejection rate. This could be supported by potentially two observations in the data. First, there's higher correspondent lending share in low-income areas. So these low-income borrowers are disproportionately exposed to correspondent lending. And when correspondent lenders have to cut the lending, the marginal cost of lending to low-income borrowers might be higher. This could be due to that origination costs to low-income borrowers are higher. And the second is that when they cannot sell the mortgages with servicing release, they have to bear the monitoring cost of these low-income borrowers when they hold the loans on the balance sheet. I wish I could stop here, but I need to talk about how I identify the effect of mortgage aggregation on credit supply. I gathered several data sources. First, Home Mortgage Disclosure Act data. That allows me to observe application level loan characteristics, borrower characteristics, and identity of the lender in this market. In the HOMDA data set, there are three parts: origination, purchase, and aggregation. In the origination part, a lender in HOMDA, they would record a loan if they make the credit decision for the loan. And in the purchase data set, a lender would record the loan if they aggregate the loan from other lenders in this market. The second data set I used is the Fannie Mae and Freddie Mac data set that allows me to look at the interest rate and performance of the loans gathered from different channels. The third data set is the bank and shadow bank card reports, which allows me to control for the financial characteristics of majority of the lenders in this market. Finally, the American Community Survey, it's just to control the county level characteristics. So how I constructed the sample. Here I have constructed a new data set for aggregation network. There have been studies on the aggregation network before. For example, papers by Nancy that looks at their aggregation network for subprime loans before the financial crisis. Here, I'm trying to establish an aggregation network in the post-financial crisis period. The way I do it is that try to merge the originated mortgages with the aggregated mortgages in the HOMDA data set. In the public HOMDA data set, there is no unique loan ID that can link originated loans with aggregated loans. So I have to rely on where the loan is originated, the loan amount, and other loan characteristics that are provided in both data sets. Part of the contribution of this paper is to provide some stylized facts about the aggregation network. In the data that I constructed, there are on average 500 aggregators every year, and a median aggregator aggregate loans from 7 sellers in the market. And aggregators are usually large. They originate around $2 billion mortgages per year, and they aggregate around 764 million mortgages per year. For the correspondent lenders, they are on average 5,000 correspondent lenders per year, and the median correspondent lender sells to 5 aggregators. The correspondent, just based on the volume of the mortgages that they originate, we can see that the correspondent lenders are way smaller than their aggregators. Next, I shows a subset of the network structure in this market. As we can see from this graph, the blue dots are the top aggregators in this market. And the red dots. The blue dots are the rest of the aggregators and the correspondent lenders. The main aggregators in this market are US Bank, Wells Fargo, JP Morgan Chase, Fannie Mac, Franklin, American Mortgage. So in this paper, I try to look at how disruptions to these links, how a possibly exogenous decrease in aggregation volume might affect lending and the distributional impact on borrowers. So what possibly exogenous shock that I can use here? I'm trying to use the US implementation of Basel III capital requirement on mortgage servicing rights. The treatment was announced in Q2 2012. It's largely different from international standards and largely unanticipated by the financial institutions in this market. How is this relevant to the mortgage aggregation activities? The relevance comes from the fact that aggregators usually gain servicing through correspondent lending. It's not clickable. Okay, so there are several reasons to believe that there is such a correlation. First, mortgage servicing asset is an asset that created when the loan is securitized. When correspondent lenders sell the mortgages to the aggregators, they usually sell it with servicing released. That means these correspondent lenders don't have direct exposure to mortgage servicing rights on the balance sheet. And aggregators, they usually purchase loans from other correspondent lenders in order to expand the servicing portfolio. The reason is that the servicing business is largely a scale business. They pay the fixed cost of setting up a system for servicing, and they gain profits by pumping enough volume into the servicing system. One way for them to pump enough volume into the servicing system is to purchase mortgages from other correspondent lenders in this market. So it is not surprising to see that there is a positive relationship between their aggregators' exposure to mortgage servicing rights and the market share in the aggregation market. So if there is a punitive MSR treatment, there would be a decrease in aggregation volume. And through the network, aggregation network, the connected correspondent lenders would adjust the credit supply to borrowers. I constructed the following measures to measure to what extent the aggregators and the correspondent lenders are exposed to mortgage servicing right exposure. The aggregator level exposure comes from the Bocek et al. 2018 paper, where I measure it using the MSR over Tier 1 capital. And the correspondent lender level measure comes from a body style treatment variable, where the treatment intensity comes from two parts. First, to what extent the connected aggregators are affected by mortgage servicing rights, and to what extent these correspondent lenders are exposed to these affected aggregators. After constructing the measure, I run the following correspondent lender level analysis, where the Y variable is the origination volume or the aggregation volume that a correspondent lender have. And the main dependent variable is the interaction term between the mortgage servicing right exposure through the aggregation network times a post dummy. And a negative beta here would mean that a correspondent lender that is more exposed to Basel III capital requirement on MSR is through their aggregators are more likely to decrease the amount of mortgages that they sell to aggregators or the amount of mortgages that they originate. Next, I'm going to talk about how this aggregation, how the credit supply would be affected by this aggregation network. I first show that the Basel III capital requirement will decrease aggregation amount through this correspondent lender level analysis. As we can see from the coefficient that it's negative and significant. So for a correspondent lender with higher MSI exposure, they would experience lower aggregation volume. For one standard deviation increase in MSR exposure, there is a 10% decrease in the aggregation volume. Next, I show that this also affects the origination volume. Here, I split the sample into correspondent lenders that have agency access and those correspondent lenders that don't have agency access. The reason to do that is to achieve a cleaner identification, because for the set of correspondent lenders that have agency access, we can see that the negative impact on their lending is largely muted. And if we look at the set of correspondent lenders that do not have agency access, one standard deviation increase in mortgage servicing right exposure leads to 4% decrease in origination volume. Apparently, there are a lot of identification concerns here, because if we look at the origination volume or aggregation volume at the correspondent lender level, first, it could be driven by the loan demand for correspondent lenders. If the loan demand for correspondent lenders is possibly correlated with the treatment intensity, then we cannot distinguish these two driving forces. We don't know whether it's coming from the supply side or demand side. To address that problem, I conduct two analyses. The first is the correspondent lender aggregator per level analysis. This analysis allows me to control for the correspondent lender year fixed effects that partially controls for the total amount of mortgages that a correspondent lender have to sell to the aggregators that it's connected to. So I'm just comparing the same correspondent lender, but they are selling to different aggregators with different level of exposure to MSR. And the coefficient would represent to what extent the aggregation volume is decreased from a more treated aggregator in the network. The second analysis that I did is to have a lender county level results with rejection rates as dependent variable. I can control for the county year fixed effects to partially adjust the demand side problem, and rejection rates also partially adjust the demand problem in the analysis. Second, there might be non-random match between correspondent lenders and aggregators. So to do that, I first show that there are parallel chains in both purchase amount and origination amount at the correspondent lender level before Basel III capital requirement, and the divergence in their aggregation amount or origination amount really happens after the Basel III capital requirement. It's a pity that I cannot show the graphs here, but believe me, the results are there. The second is that I explore the relationship formation between the aggregators and the correspondent lenders. This could be
Technically, it's yours.
I hope my time is not up now. Thank you very much. I have random clocks, alarms from time to time. I just forgot to turn it on. I'm sorry for the disruption. Yeah. So explore the relationship formation between the correspondent lenders and aggregators due to merger and acquisition that are not coming from, are not driven by the goal to acquire the aggregation network. Lastly, I look at the correlation between exposure to treated aggregators and direct treatment effect from the Basel III capital requirement, because a subset of the correspondent lenders are actually banks. If there is a positive correlation between the capital shortfall and also the treatment intensity coming from the aggregation network, then I cannot distinguish which forces are driving the results in origination amount. And I show that there is insignificant correlation between Basel III capital requirement shortfall and the treatment variable that I constructed at the correspondent lender level. So why does aggregation matter for origination? I show that is because of the matching frictions between aggregators and correspondent lenders. There is a sticky relationship between aggregators and correspondent lenders in this market. For aggregator that serves as a prior aggregator for correspondent lender, it has 50 to 60% higher probability to serve as current aggregator. And headquarter distance is a very important determinant for relationship formation. For a correspondent lender that is closer to an aggregator in the market, it's more likely for them to form relationships. Even though now the technology has developed so much, this has not changed that much across time. And small correspondent lenders are more likely to subject to this distance constraint. That is probably because they face higher level of asymmetric information in terms of relationship formation. Then I show that origination volume reduces more when correspondent lenders have ex ante smaller number of aggregators, high concentration in selling mortgages, and a small number of nearby aggregators. Finally, I turn to the aggregate effects. To examine the aggregate effect, I utilize the regional heterogeneity exposure to bank aggregators before Basel III. And the treatment variable is in the same spirit as the treatment variable I constructed for correspondent lenders, where the exposure is weighted by their aggregation market share. Again, I tested the same parallel chains in purchase and origination volume. So in the last part, I try to understand whether the decline in aggregation volume has an active impact heterogeneously on low-income borrowers. That is motivated by the observation that correspondent lending share is much higher in low-income areas, and there is an active relationship between the correspondent lending share and the local income. Another reason to believe that this might have different impact on borrowers that fall into different income group is that correspondent lenders, they might decrease the subset of the credit supply to a subset of borrowers that have higher marginal cost of lending. After the Basel III capital requirement, these correspondent lenders, they cannot sell mortgages with servicing release that much as compared before the Basel III capital requirement. So, so these correspondent lenders, they have to somewhat bear the monitoring cost for these borrowers in this market. This is a very preliminary result that shows the effect at the county level on low-income borrowers. And I looked at the subset of the correspondent lenders that with no agency access. Ideally, I should plot these across the income groups of the borrowers, plot the coefficient across the income groups of the borrowers. But I haven't done so yet. That is on the to-do list. To conclude, in this paper, I document new empirical facts on aggregation network in the US mortgage market in the post-crisis period. And I find that mortgage aggregation actually eases securitization frictions for the correspondent lenders in this market. The decrease in mortgage aggregation reduces mortgage origination by correspondent lenders. And I highlighted the impact of matching frictions in aggregation market on credit access to low-income borrowers. Thank you very much.
Great, thank you so much, Keling. So the discussant is YK Yusu Kim from the Federal Reserve Board.
Right. I'd like to thank the organizers for the opportunity to discuss this paper. This is a very nice paper. Keling put in a lot of efforts into this paper. I think she's going to put in even more efforts over the summer to prepare for job market. And this is a great paper with very close to my research agenda. And before I say anything further, usual disclaimer applies. So Keling presented another version of this picture, just another take on this sort of market structure of the origination securitization. So this is basically two main ways to originate and securitize loans into MBS in US. Starting from left, I have integrated originator channel where integrated originator make loans to consumers directly and then they securitize their own originations into MBS. I call it integrated originator because they do origination and securitization within the same entity. And then we have correspondent aggregator channel where the origination and securitization are separate, done by different entities. The origination is done by correspondent lenders who makes loans directly to consumers, and then they sell loans to aggregator big institutions, and they collect these loans from small correspondent lenders and then securitize this. So basically, aggregator, they connect the small correspondent lenders to MBS market, although these small correspondent lenders do not have direct access to the MBS market and secondary market capital, right? So, and this, as Keling showed, that these aggregators, they account for a large share of the mortgages securitized into agency MBS. Their share has declined somewhat over time in the past decade, but still, for GSEs, the picture on the right, their share is still above 20%. But in general, the purchase loan, the aggregators matters more, and aggregators matter most for Ginnie Mae loans, like FHA, VA loans that are used for home purchase. So that's probably why the Keling finds more stronger result for low-income borrowers. I think the main reason, one of the reasons why the Ginnie Mae have high aggregator share is has to do with the institutional setting, right? The GSE have cash window option where that small lenders can get cash back by securitizing themselves, but Ginnie Mae doesn't allow for that option. So who are the top aggregators and top integrated originators? So I compiled this table from the data for loans securitized into Ginnie Mae MBS for 2010 and 2020. So there are basically two main takeaways from this table. First, in 2010, big banks used to dominate both aggregation and integrated origination. So if you look at the top list, like Bank of America, Wells Fargo, they show up as both top aggregators and top integrated originators. But if fast forward into 2020, you see very different names. Like the top aggregators, basically PennyMac, Freedom, NewRez, all of which are non-banks. Integrated origination, Freedom also shows up there, but you have Quicken Loans and United Shore. So this the aggregation and the integrated origination activities migrate towards non-banks, but towards sort of a different set of firms. In the GSE market, I didn't report GSE here, but there's basically similar patterns there, but there are more bank presence still. And this shift to banks to non-bank activities actually is much more pronounced in aggregation and securitization activity than the originations in some markets. So this is for the FHA home purchase loans. I plotted both non-bank origination share. This includes non-bank correspondent lenders selling loans to aggregators, bank or non-bank. Red line shows share of the non-bank securitization, which includes non-bank aggregators. You can see that both shares went up dramatically, but the increase is much larger for the securitization share by non-bank. So you can see that there are a lot of changes that happened in this aggregation market in the past decade. Right. Despite the importance of the aggregators in how much they do securitization into MBS, and despite a lot of changes that happened in this market in the past decade, there has been very little work on the aggregators themselves. So there's just two papers, one paper by Nancy and her co-authors, which provides a theoretical model for like intermediation network for these mortgages. So the linkages between correspondent lenders and aggregators. And then I have shamelessly advertised my own paper. I have recent paper with Karen Pence. It's talk about the shift of the aggregation activity from big banks to non-banks and how that affected the credit box and then the mortgage costs. And then there's a Keling's paper. The main message from the paper is liquidity from the aggregators that matters a lot for credit supply. And this is a very nice paper with huge potential on this important but understudied topic. Right, the main ideas of paper is that bank aggregators, when they reduce the amount of loan purchases from correspondent lenders, the correspondent lenders reduce overall originations and overall credit supply also decline as a result. The main identification to get at the bank aggregators reducing their liquidity towards correspondent lenders coming from the higher capital costs of the mortgage servicing rights under Basel III. There are actually two components in the rule. So first one is increase the risk weight for MSRs to 250%. And the second one is a punitive capital treatment for MSR, basically capital deduction for the portion of MSR that is above the 10% of the common equity tier 1 capital. And in this paper, like Keling focuses on the second part, the banks with a higher ratio of the MSR to CET1, and ignores the first part, the risk weight part. I think this actually makes sense because the effective risk weight for MSR was already 215% even prior to the Basel III capital rule for larger banks. So I think this is completely reasonable approach. And if you need additional resources or the information about how this rule actually worked, I highly recommend you read this, the Interbanking Agency report on the mortgage servicing asset. It has a lot of information about how this rule works. And although the paper is great, there are some issues I'd like to point out. So first one is this MSR percent measure, which is the basically main treatment exposure measure she constructed. It is measured in the 2008 data. But the treatment actually started in 2013. And my main issue is that there are a lot of changes that happened within this short time frame. So this is top Ginnie Mae aggregators in 2008 and 2012. And so in the 2008, the top one is countrywide, and you also have City Mortgage and GMAC. They were top in 2008, but they all disappeared even before 2012. So even before your treatment actually started, these top firms disappeared. Countrywide was acquired by BOA, but BOA exited from the correspondent lending business even before the treatment started. So because all these big aggregators that contributed to your treatment measure disappeared before your treatment actually started, I'm just wondering why this treatment exposure measure actually captured. So my suggestion to you is very simple. You just want to calculate this MSR percentage measure using like more the 2012 data right before the treatment actually starts, and then just see whether your result actually holds up. My second point is your county level regression do not really rule out non-aggregator channels. So as I showed in the beginning, the large aggregators back then also securitize their own origination. So Wells Fargo, for example, was both top aggregator and top integrated originators, securitizing their own originations. And integrated origination also creates MSR because they are securitized into MBS. So in theory, bank with a high MSR might have just reduced both aggregation and integrated origination, which contributes to your aggregate credit supply results. So my suggestion to you is that just check whether you find any effects on integrated origination separately. You can do it with a HMDA. So you might actually indeed find that there is no effects on integrated origination. You only find effects on aggregation because aggregation is probably a cheaper way to increase your servicing portfolio. So this is maybe the first thing they scale down. So but you can just check it. My third comment is your sample period coincides with a lot of the timing of a lot of other changes that happen in the housing market. So there were large swings of house price growth and delinquency rate that just the varied across region. They might be just correlated. They could be correlated with your 3-month exposure measure, and then this could be correlated with your credit supply. And then GSE made aggregation business less profitable during this time by stop giving discounts of the G fees for big aggregators. So that also affected the incentive of aggregators. And then there's financing programs like HARP that could have, it's also the exposure to HARP that could be correlated with your exposure measure. And then lawsuits against big banks, which affected a lot the FHA aggregation business. So which could be also potentially correlated with your measure. So, and yes, I'd like to see some kind of balance table between, for high MSR percentage measure counties and low counties, and then see whether this exogenous variable actually is balanced. So ideally, you want to show some kind of long-run trends of these housing market variables sort of parallel, going parallel between these two group of counties, even starting prior to GFC. How many times? Okay. I have other comments. I just communicate this comment offline to Keling. So this is a very nice paper with large potential to make great contribution to this understudy topic. There's some issues, but I think it can be easily addressed. So looking forward to the next one.
Great, thanks so much, YK. So why don't we take some questions?
Dan Garrett, Warren, really nice paper. It's really interesting. I was wondering, it seems like one of the things that's required to measure your measurement is the corresponding lenders actually existing. And it seems like there's a big extensive margin here that I didn't quite understand how it could be measured. And I was wondering if that's maybe a part of the story and if that means that we should think about what you're looking at as kind of lower bounds, if there's kind of an extensive margin response.
I haven't measured that yet in this paper, and I think it might be hard for me to do that. I will think carefully about this question. I don't have a good estimate for the lower bound right now.
Hi, Ethan Freshwater from Rocket Companies, Rocket Mortgage. So one perspective from an independent originator on this comment section was Basel III also has risk weights for uncommitted warehouse lines. So depending on the impact of that requirement of Basel III, do non-banks actually have an opportunity to grow market share in the correspondent space as banks step away outside of the MSR implications?
The answer is yes, and I do find that in areas that banks are more exposed to Basel III, there is a higher increase in the shadow bank share, and we do see that in the data, which is also documented in King's paper, that the increasing presence of shadow banks in aggregation business. And also, like, the shadow banks are generally have experienced large growth in this time period, so they are also increasing the presence as correspondent lenders in this market. And there is also an increase in the shadow bank aggregator correspondent lender share in this market. I think you're right on the point that it's a change in the past 10 years.
Since we've got a couple of minutes left, do you want to respond? Any reactions to YK's discussion?
So one response in terms of their effect driven by GSEs or FHAs is that, yes, I do believe that part of the results are driven by FHA market, but there is also quite a low overlap between the GSE mortgage characteristics and FHA mortgage characteristics. So I think there is some reason to believe that part of the decline is also driven by GSE mortgage market. And in terms of the treatment measure, I constructed two versions of the treatment. In the current version of the paper, I reported the results using the treatment measure from 2008. And in another version of the results, I reported the results based on treatment measured in 2011, and the results are quite similar. In terms of the other points that King has raised for my paper, I think I will have a more detailed discussion with him. Thank you very much.
Great, thank you so much. So why don't we move to the next paper then? So the next paper in the session is Algorithmic Underwriting in High-Risk Mortgage Markets, and David Zhang from Rice is going to be presenting the paper.
Great. Great. So thank you so much for inviting me. Really honored to be here. Today, I'm going to be talking about algorithmic underwriting in high-risk mortgage markets. This work is joined with Janet Gao from Georgetown and Libya Yi from Boston College. So first of all, what is underwriting? So underwriting we think of as a screening procedure where lenders are collecting information, processing information, and kind of determining the creditworthiness of borrowers. And, traditionally it's been performed by humans, but it has become increasingly automated. Right? In the U.S. mortgage market, right, this since the 90s, right, the automated underwriting systems have become increasingly prevalent. In other markets, for example, auto lending, trade credit, that's also becoming increasingly prevalent. So the research question in this paper is, how does the increasing reliance on automated underwriting affect the trade-off between risk management and financial inclusion? And we do this by looking at a particular policy change, okay, FHA policy that transitioned from pure human underwriting to increased reliance on algorithmic underwriting for a high-risk group of borrowers in August 2016. Okay, so the affected group is a group of borrowers with FICO scores that are below 620 and debt to income that's above 40. So both are very high-risk indicators. And for this group of borrowers, prior to August 2016, they had to go through human underwriting, where human had to gather documents and provide evidence for why they should be approved. Whereas later on, this group of borrowers were evaluated first with automated underwriting systems before being passed on to humans. So what happened? So I'll briefly talk a little bit about the data, and then I'll talk about what happened after the change. So we use 4 data sets in the paper. Main ones are the Ginnie Mae data, which is the universe of FHA mortgages. It includes variables such as interest rates, delinquency status, DTI, credit score, and other underwriting variables from 2014 onwards. And we merged that anonymously with HMDA data, so which gives us the race, ethnicity, and income demographics. So for those of you who try to merge yourselves, if you merge the two directly, it's very difficult. The noise is very high. But we use intermediary data set that's basically the FHA endorsements that has some elements that are in common with each of these subsets, and that helps bring the range of merge rate up. So we also have some results in terms of real outcomes, location choice, using Experian data. So that's the consumer credit panel. And we have some results from, we do some robustness checks with CoreLogic and RMA, which has certain other variables. So the policy window in our study is going to be before and after this event of August 2016. Right. So now that I've talked a little bit about the data, let me talk about what happened. Well, first of all, there was a fairly large, extensive margin increase in volume following the policy. So in this graph, the x-axis is the date of origination, or month of origination, and the y-axis is the share of mortgages with DTI above 43 within a subgroup. The red line is the group of borrowers with credit score under 620, and then the blue line is the set of borrowers with credit score above or equal to 620. Okay, so if we think of the red line as the group of borrowers that's affected by the policy, right? We have the blue line as the group of FHA borrowers that's not affected by the policy. It's kind of a control group. And you can kind of see, right, at least afterwards, right, there's some general, the ups and downs that are somewhat parallel. But there's this big spike, right, at the time of the policy, where the share of mortgages with DTI about 43 jumped up quite a bit for the affected group, from about 10% to about 40%. So we can also do this by DTI bin. Okay, so this is the essentially the before and after analysis, where the x-axis is integers of debt to income ratios, and the y-axis is the change in log loan count. And you can see that below 35 DTI, there doesn't seem to be much of a change. Above between 35 and 43, there might have been some decrease in volume as some borrowers increase their debt to income ratios. And then above 43, there's this large percentage increase. Now, some of this shift, right, it could be due to borrowers that are taking out larger loans. It could also be potentially income manipulation, right? Maybe I was reporting more income before, and now I'm reporting less because I don't have to. So this intensive shift in volume, right? It could it may or may not be due to the intensive margin. But what we show in the paper is that but the extensive margin wouldn't be affected by any kind of manipulation or this kind of manipulation. And the extensive margin we show is about 10% of the number of loans taken out by the treated group. So we focus on the extensive margin in the paper. Although if you take the income as accurate, right, rather than manipulated, we also have about a 5% intensive shift. It's smaller than the extensive margin. Okay. Finally, right, we quantify the policy impact across DTI by estimating a counterfactual DTI distribution. So this is from using a methodology of diffuse code Johnson Mondragon. The restud, the assumptions are first of all so it's just essentially a triple difference type analysis, where the assumptions are, first of all, there's a group of borrowers that's unaffected by the policy, and we usually take to be the high credit score borrowers. Secondly, we say there's a very low DTI group of borrowers that's unaffected by the policy, and essentially the growth, the counterfactual growth in loans without the policy is going to be the sum of the pre-event distribution plus the change in distribution for high FICO borrowers. Okay, so this is essentially applying a parallel trends type assumption for each DTI bins, taking essentially this region as a control group, and then also the FICO above 620 as a control group. So if you do that, right, you get this very nice counterfactual distribution, where you see that empirically, right, the line is in solid in orange, and counterfactually, it would have been in this blue, dashed blue. And what you see is that there's without the policy, there would have been a lot fewer loans in the high DTI segment, and more bunching at DTI equals 43. Under 30, right, it looks like there's some the empirical and counterfactual lines line up quite well, which is nice in that it's not purely mechanical. There's only the two adjustments. There's the treatment when control, and then there's the under 35 adjustment, which is just a constant adjustment. So the fact that even the wiggles line up is quite nice. Okay. So based on this graph, right, cutting it up, we have the extensive margin of basically 10% total loan growth. There's some decrease in threshold, decrease in bunching, but as I mentioned earlier, it could be due to income manipulation or people getting larger loans. That this part is a little harder to interpret. And also at least the average change in DTI for originated loans is 1.3. So how does this affect? How does this effect differ across income and racial groups? Right. So we show that there's actually very large differences across income and race and ethnicity. In particular, for the effects are basically concentrated for borrowers who are above median income rather than below. So we for below median, for overall, right, there was a 10% extensive margin increase among the affected group of borrowers. But among the group of borrowers with income that are above median, the increase was 13.6%. And then below median, it was only 3.8%, and not statistically significant. Right. Across race and ethnicity, right, we see there's 10% increase in non-Hispanic white borrowers and Hispanic borrowers, but essentially no increase among Black households. Right. So this is, we find this interesting in that, one promise of algorithmic underwriting was, maybe to make things to help with the distributional goals, but it didn't seem to occur here. So we look at the mechanisms a little bit in the paper by building a structural model and looking at how much of this is due to differential supply expansion for different groups, and how much of it is due to differential demand, right? Demand response to the policy. And we separately identify supply and demand essentially by looking at the changes in bunching. Because bunching, regardless of the source, is indicative of there's some constraint in the market that's forcing some people to be below the threshold. So looking at the changes in bunching gets us the difference in supply, and then the remainder is the difference in demand. And what we find there is that actually the income results are mostly driven by supply. So even with the move to automated underwriting, it seems like the underwriting algorithm was expanding supply to higher income borrowers more than lower income borrowers, which makes sense, as income is something that they probably underwrite on, and that explains this differential, or a large part of this differential. Among race and ethnicity, there's a little bit of a supply difference. I think we show there's also large demand differences, which suggests that just expanding the supply to these groups doesn't necessarily lead to more financial inclusion. There could be other constraints, like down payment constraints, information constraints that are preventing take-up. So it's not sufficient. It seems to simply increase supply. Okay. And then we naturally we look at delinquency risk. That we saw this big jump in volume. Right? What happened to delinquency? Well, at least conditional on DTI and FICO score, there wasn't much. So it was a slight negative, slight decrease in delinquency rates among the affected group, and then essentially zero among the lower LTV group or lower DTI group. Now this is we've talked about this with people at the FHA, and they kind of confirm that this is something that That's consistent with their experience, and the interpretation they gave was basically that humans weren't as helpful as one might believe, and that resources should be spent making these algorithms a little bit better rather than fine tuning the human underwriting guidelines. So that's the general takeaway. But of course, there is still even though like comparing between humans and machines, right, there wasn't much of a change in delinquency. There was still a large increase in delinquency overall because now we are making a lot more loans to these low FICO, high DTI borrowers. So in the paper, we also look at what happened to the FHA market from this policy change, which is going beyond just comparing humans and machines a little bit, but now just more about evaluating the policy. And in terms of the policy, we see essentially there's about 15% increase in dollar volume for the affected group. This is a very large increase in the amount of credits applied to this group. 1% increase overall for FHA volume. And then for delinquency rates, these are like 2-year 90-day delinquency rates. It's 3% increase in the treated group, and then 1.6% increase overall. So the treated group being essentially 2 to 2.5 times riskier than the other groups. So there was definitely so you can think about evaluating this in various ways, right? Is it a good policy? Is it a bad policy? So FHA has some published opinions saying that they view that this kind of loans is socially beneficial. We have a little welfare calculation in the paper that says under certain assumptions they might be right, but of course, there's various caveats to the increasing supply to this group. Right. So what about real outcomes? We've given that low credit score households now have improved access to credit from this policy, right? This 10% extensive margin increase, 15% volume increase. Do they become more mobile and migrate to neighborhoods with higher school quality? So to evaluate this, we use a two-stage least squares approach. The first stage is we do a run regression on whether the household got an FHA mortgage or not, and then in the second stage we use the instrumented version of the whether the household got the new FHA mortgage or not, and look at the effect of the mortgage on changes in school ratings. The treated group is equal to 1 for individuals with FICO under 620 in 2015. So looking at that, we see this a very large, very significant first stage, right? After the policy, the treated group has a significant increase in obtaining FHA mortgage, and the magnitudes are also somewhat reasonable, with consistent with the other analyses. But in terms of the second stage, we find that there was this large increase in school quality. Well, so the school quality was rated from 1 to 10. Right? So this is somewhere like 1 to 10, 1 to 2 point increase, or about I think half a standard deviation increase. And it seems so we add a lot of controls here, right? We have individual characteristics, we have age group, gender, whether the household is married, and so on and so forth. One kind of test that we do is, you might worry that some of these results may be driven by the treated group, right? The low FICO borrowers just migrating to better neighborhoods more generally during the time period. So we also do a placebo test with renters, and we find essentially no results among renters. So this is all among households who transition from renting to owning or transition from owning to owning. Finally, we, as I mentioned earlier, right, we use the structural model to separate this demand and supply. The intuition is of the model, as with all the kind of bunching papers, is that we assume that there's the demand for DTI is smooth, but there's kinks in the empirical distribution, which is driven by the supply restriction. So changes in bunching, then that identifies the supply expansion. It's a remainder identified by demand. Okay. So how much did the supply expansion change? Well, there was essentially the model implies there's a 100% increase in supply for high DTI eligibility in the full sample, a little bit less among Black households, and less among below median income households, and much more for above median households. Right. So we could quantify these numbers we could check what these numbers imply about what fraction of the disparities is explained by these supply differences versus demand. And as I mentioned earlier, like the income difference in supply is huge. Right. So that explains a lot of the income differences. And then the racial difference in supply is still there, but it's less. So demand also plays a big role there. So in conclusion, so what have we learned from this policy? We found that the increased reliance on algorithmic underwriting, can help increase financial inclusion while controlling risk, controlling conditional observables. So they seem to be able to underwrite approximately as well as humans can, which may increase efficiency, and at least in the model led to sizable gains in consumer welfare. Now for society, the trade-offs are not as obvious, but at least the stated position of the FHA is that it's these risk levels are of loans at these risk levels are of net social benefit. Now, interestingly, this increase in financial inclusion was not equally distributed, but concentrated among white and higher income borrowers. And that highlights the role of both demand and supply factors in limiting financial inclusion for these subgroups. That's which is our takeaway from that. Thank you.
Great, thanks very much, David. So Nancy Wallace from Berkeley will be the discussant.
So thank you very much for having me discuss this really interesting paper. I wrote too many slides and I have a plane that I have to catch. So I'm going to skip some of the slides that go through the paper. So what does this paper do? So it's an analysis of this 2016 FHA introduction of algorithmic underwriting as a supplement to human underwriting for Ginnie Mae originations in the less than 620 and the over 43 DTI. It has two really interesting parts, as David said, the reduced form of the AUI policy change on lender risk management, I'm going to call it. And so, and this is tested. They have various channels they're looking for, and it's quite convincing in terms of what the channels are. They term one of them efficiency channel, and that's measured on the performance of these loans. And what we see is they're originating a lot more. The extension margin has been pushed way out, and the performance losses relative to that huge expansion are relatively moderated, even though they're like 5%, but still it's small. And so they massively increase capacity, or the enhanced capacity, I should say, but not within markets that were very congested, which was somewhat surprising. And then it also, one of the other issues, which you didn't really talk about this afternoon, but I think is very important, of how much the regulators were looking over their shoulder in terms of doing this type of underwriting. That seems to have been important, in that the more regulated institutions were doing more of this successfully, and their extensive margin was shifting out considerably. So that's all really interesting in terms of thinking about the lender risk management problem, and how this assisted in expanding credit for what they do and how they think about what they're doing. And then the other part of this, of course, includes borrower financial inclusion. So that gets back to our panel yesterday and some of the conversation today about how we solve that other tension, and that we're expending out this extensive margin into, part of the effort is to expand into underserved groups. And so there we have to start worrying about disparate impact, moving to opportunity, and pricing. And that's where there's a significant tension in terms of what they find, in that the headline information is, yes, expansion, but it's mostly going to the more income advantaged, and certainly the more ethnically advantaged, and it's mostly going to white borrowers. So that's a really interesting feature of what's gone on, and really reflects the conversation again on our panel yesterday, which is, this is a real tension. We're not making much progress here. Why? And then they do the structural model, which I like a lot. Your graph for the first part of it, using DePusco et al., that is a beautiful graph. And so the paper's all about the graph. I have that in my discussion too, because it's beautiful. And also the parallel trends. This thing fits really well. And then they do a structural model, which is really interesting. And they're interested in the estimation of borrower welfare measures reasonably. And here the headline result, again, is that a 1% change in borrower, the DTI change, and sort of shifting out this expanded, more broad view of the concerns associated with DTI, reducing those, is equivalent to a 59 basis point decrease in their contract rate. So that's a pretty big headline result. And that's really very, very interesting. So I'm going to skip this, other than this beautiful graph, which it is really beautiful. Kudos to you. And I was going to talk a little bit more about the structural estimation, but I want to talk about some of the challenges. So this gets back to this tension between trying to address the underserved communities in our mortgage underwriting, and how severe this trade-off is in terms of the increase in performance, or decrease in quality of performance, but increase in the extensive margin, but not for populations that really we were hoping to achieve more access. So I began to think about a couple of things and started digging around to try to understand of what is the AU that's being used here. And so what you do, and when you go look this up, is what they say is that the AU is, it's a new underwriting, a total scorecard, and it's a machine learning application that was developed in 2004. I don't know how cool the machine learning was at that time. But anyway, but we know very little about this. And given all the interest in using machine learning and all kinds of more and more complicated non-parametric models, a reasonable question is obviously the application of AU. There's a big residual on that. There are a lot of things we need to know about that AU, like what's the mathematical structure, what are the statistical properties, how should we think about the estimation errors, what data are used to fit this algorithm. So this is a 2015 treatment effect with a model that nobody's being very transparent about what it is. And we would, I think you should be very curious about what that is. That's a big part of some of these issues. And then also the contracting space, and that your data sets are going to limit your contracting spaces. And the important ones that are not there for you are points and origination fees. And I'm especially going to be interested in origination fees. And that was part of this morning's discussion. How those are being measured, what's available in the data set that we're applying this new AU thing to be better than human beings. And so I do this a lot. I'm very concerned about some of these models. And as all of us know, these data sets are very, very extremely imbalanced. So we're applying these very complicated non-parametric or not. My guess is the AU is, well, we have somebody that knows what the AU is a linear model. It's probably logistic regression with whatever. And they don't fit well, especially these really imbalanced data sets. So there are significant residuals. And let's say it was a really fancy one, which I very much doubt, but maybe we could ask somebody that's sitting here. What these models do, even when you're using very complicated nonlinear models, they give you back the data. And so this is looking at the residuals from applying an XGB boost to a very big data set with millions of observations. And basically, as you can see, who have the bigger residuals? Well, they're African-American and Hispanic borrowers. And so those are the ones that are getting rejected. That's what the models do. And it has a lot to do with just the frequency. And this is just FICO score, that in some of these bins for these minority borrowers, there's just no data there. And obviously an AU model is not going to give you anything better than a human being. And so it's sort of a misinterpretation of what AU can give you at any margin, but certainly in terms of affording more access. Then I also was curious as to why did we have this change? Like what was going on that gave us this DTI change? And, I try to get my students to think about like policies relative to forecasting, and then you have to think about Lucas critique. And this is really a problem with this particular treatment policy variable, in that if you look at the FICO data just before it, what you see massive rejections because of DTI. So that was the big push. People were very concerned about this. There was huge uncertainty about which dimension of the contracting space we should really be obsessed about. And it was a policy variable we knew very little about. Truth in lending laws were being written under Dodd-Frank, and we zeroed in on, for whatever reason, DTI. And yeah, I think that's also kind of problematic in terms of the uncertainty of these macro features. And then we're going to build it into a model that's forward forecasting. And for sure, you're going to make a mistake. The other thing that's really interesting, if you look at the data, this treatment of 2016 is kind of the birth of the dominance of non-banks. I have no idea why. I was shocked by this. But look at this. I mean, when you line this up on the growth of non-banks and origination, it lines up perfectly. And then you look at just the Gini, there's a kink. It's another kink you could use on your, there's a kink, and then the Gini just takes off in terms of being non-bank. And of course, there are algorithmic underwriters, many of them, and so it sort of makes total sense. Okay, but now we need to think about what you're missing in these models. And one part of this is how do we disentangle this disparate impact policies? And this is where there's a lot of work going on right now about the fees. And why are the fees so high? And what's the incidence of these fees on various parts of the credit market? And this was a Bloomberg article that my friend Karen, who knows a great deal about these markets, sent me. This is pretty amazing. So these are differential fees for Latinos compared to whites in high Latino homeownership markets, like the LA Basin. Their fees are dramatically higher by $200, $300, $400, $500, with people that have origination fees of $10,000. Why is that happening? Is it the broker originator? So this is now the tension between who's doing the origination. Is it brokers? Is it correspondents? Who are these lenders? And then the lack of shopping in some of these language limited or access limited markets and other barriers. We're not sure what. And again, FHA, these are purchase loan differentials. We see huge, even off the LLPAs, differences. On the right is the firm minority share decile. So firms that do more in given ethnic groups charge more. That's a weird result. And similarly, census tracts that are more heavily minority are also paying more relative to the LLPA. So again, we have these differences. We're not sure why, but you apply an AU model to that, it's just going to give you back rejection rates. This is back to the non-banks charging Latino borrowers higher fees by substantial amounts. I went and looked at the HMDA data for 2019. This is when we actually can see it. And for various DTI buckets, we see again, higher fees by DTI bucket. And who's paying the higher fees? It's minority borrowers. And then the last picture is the non-banks charge higher fees by rate spread. So all of this is contributing to this filter of eliminating these people because they're not just getting the DTI advantage, they also have this other dimension in the underwriting space where they're being significantly disadvantaged on pricing. So this is a really interesting paper, but I think it raises this question in a really nice way. And I think you could do more with it, of the tension between moving the extensive margin out with some kind of single element in the contracting space, and then ignoring the pricing overall across all the features. And I think you could make a really big impact paper if you try to reach to that other piece by using some of this data and understanding why that possibly is happening. I really love the paper. Your graphics are fantastic, but I think this is a real thing that we need to think about. Thank you for letting me read it. I highly recommend you all read it. It's a really great piece of work. Thanks.
Great, thank you, Nancy. So why don't I take some questions?
Excellent paper. I need to read it. I was the one that made that change. And it's interesting, but let me sort of, so there's some questions here. We should have private discussions, but excellent paper. And it was interesting to see sort of how big of an impact it had in the market without raising default rates by that much. So in some sense, that's great. I think, you know, and the use of automated underwriting versus manual and what these models are. The interesting thing is that as much as we talk about machine learning and big data, most of the mortgage market still overrides. Something like 2/3 of the GSEs, they call them cautions, I call them rejects. 2/3 or so, don't quote me on the exact number, but a majority of their "we won't buy this loan" coming out of our automated models are not based on the model, but are based on basically overrides. Most of those overrides were DTI. And it's unclear why that has come up. If you look at the empirical data, DTI is not very predictive. You point out reasons, it could become more predictive, but it's not really a big factor on risk. And yet you had an entire mortgage industry, and as I said, the majority of the denials were coming out of something that was not in an automated model. And so, you know, this was presented to me. I won't give you, I will over a beer later. I won't go through the whole story. But this is also a period where the QM was using, you know, a lot of these things. Huge disparate impact. I'm actually surprised that it didn't, unwinding it didn't have the disparate impact favorably, but except for the Hispanics. But it was sort of a decision that since the evidence was very weak, why don't we just get rid of DTI and let it's still in the model. It was the override that we were getting rid of. So if you have a high DTI, low FICO, the total scorecard, which really is just a matrix, but we call a model, we call it the model, So we're not getting rid of it we did not get rid of it from the matrix model, but we did get rid of it as an override. And I think it encouraged folks to, think about how much of the mortgage market is still based on sort of antiquated versions of of these overrides that are not. And it goes back a little bit to what Nancy said, that there's a lot of nonlinearities here and it's hard to estimate. And you want to concentrate your estimation right around your point of your accept rejects, not, overall. Excellent paper. We'll talk more, but I do think it's important that as an industry and as researchers, we start to look at how important these overrides and customs are still in the market. So good paper.
Sylvia.
Hello.
And then Bob.
Hi, Sylvia Van Donk, Freddie Mac. Well, nice paper. Well, at Freddie Mac, we use a lot of machine learning too. And my comment to you is that, you motivated that as an opposition between humans and machines. Anecdotally and publicly, I can say that, whenever we have a better model, we have an impact, no matter where it comes from. So if you have a machine learning model that is better than a previous machine learning model, you're going to probably have the same effect that you find. So it's not humans against machines. That's a first thing, It's just that you do a better selection, okay, in terms of metrics, false positives, false negatives, whatever, but you have more accuracy. And then that's the second thing, that not necessarily a better selection, implies more an expansion. That depends on the risk environment, right? So it could be easily, you can easily think that in some junctures, you may want to restrict because of better selection. So that's not a universal law, in terms of your finding. Well, maybe it is, I don't know, but chances are that it's not, So, and I have an extra comment, about, machine learning, can be dumb. That's more or less about the discussion. It could be, profiling, and that's well known. Instead of a duck, you capture a cookie or something. So and it's prone to more profiling. In faces, face detection, criminals, and also in terms of this thing. But then you need to complement that with, LDA, least discriminatory alternatives. You need to adjust that, expose. That can be done too. So it's not an argument necessarily against that, like any other model, so that's a last thing. Thank you.
Bob, do you want to say something? And then David, do you want to respond to some of the discussion, some of the comments?
Bob Hunt, CFI. So I'm going to ask a question based on what I thought I heard, and it might carry over to the coffee, which is that there's a narrative about DTI that came from the subprime mortgage crisis that may have led to an overreaction in the GSEs that people subsequently realized was not useful, and this was a policy response to deal with it. Okay.
So thank you for all the comments and the great discussion. It's super helpful. So just to respond a little bit, so the DTI in our data for this segment is correlated with higher delinquency, right? So it's about 12% for lower DTI, and it goes to like 14 for higher DTI. It's not a huge difference compared to FICO score. FICO score is by far more important. But yeah, so there is a gradient in our data, and that's generating some of these policy impacts that I showed. So in terms of the the effect of this change from or increasing reliance on algorithms is clearly going to depend on what algorithms we're shifting to. So I think the takeaway there is that in this circumstance, right, they were able to increase volume substantially without increasing default, right? So that points to the kind of the efficacy of algorithms relative to having humans review every application. There's you know, yeah, if you could of course play with the trade-off differently, right? If you use a more restrictive algorithm, right, maybe you reduce default rates, but now you make fewer loans, right? So ultimately that becomes a policy question. But here we're more interested in what could algorithms do, right, relative to humans, right? It seems like they could increase efficiency, yeah, at least in terms of the risk management aspect. And yeah, going back to Nancy's point, that's a great point. So we found this expansion, like no change in delinquency, and then there wasn't much change in the interest rate. It was pretty flat. We didn't have data essentially on points or origination fees, but that's something that we can look into to expand the contracting space. Right. In the new Honda, we could, but the policy was a little bit before. But maybe you could look at even like at the cutoffs or yeah. And yeah, in terms of like what is like yeah, I totally take your point that the algorithms are maybe trained on biased data, right? There's group imbalances, and that could be yeah, so that could be driving some of the supply expansion differences. We kind of, yeah, to take it, we kind of look at supply and demand expansion, but take the algorithm more as a black box, just because we don't know like exactly how the group imbalances affected the. Yeah, absolutely. Yeah, happy to chat. Yeah, absolutely.
We have time for one or two more if there are more questions. Yep, in the back.
Yeah, thank you so much. Really interesting paper, really interesting topic. My kind of thought hearing this, so I've been speaking to loan officers at like smaller credit unions and CDFIs, or kind of loan officers that are more focused on sort of CRA lending for banks. And what I've heard in those conversations is that they basically say, well, what we do is like private banking. It's like a high touch kind of interaction, right? To really work with borrowers to make sure that they can qualify. It's more time intensive sometimes to make sure that we can kind of get the documentation together or whatnot, to really make sure that we can kind of achieve that financial inclusion. So I was just thinking about that in relationship to your paper, and I just wanted to kind of ask the provocative question. Well, perhaps this sort of indicates the limits of algorithms, right? Like we're seeking technological solutions for problems that perhaps can be better solved, by kind of this human touch. So just want to hear your reaction to that. Thank you.
Yeah, I think it's definitely pointing out to, I agree with you. I think it's definitely pointing to the limits of just expanding DTI for limits for some groups of borrowers, right? It's, like it was mentioned in the panel yesterday, right? Maybe, even interest rates, right? If you're just moving interest rates, a couple of basis points, maybe that's not enough. Right here, we're showing that maybe just expanding DTI may not be enough for Black households. It seems like for lower income households, as the demand in fact wasn't as stark, but for Black households, the DTI relaxation didn't help as much. So I think that points to a more kind of kind of says that if we really want to increase financial inclusion, we have to go do it through a more multifaceted approach, right? So not only have to perhaps relax DTI, but also maybe look at the down payment issues, right? Affordability issues. There's information frictions, right? These are all gonna have to come into play.